Good day, participants. Today we would be covering the chapter, the insurance contract. This chapter is chapter number 5 of risk management and insurance plan. We will see what are the basic essential features of the insurance contract vis-a-vis the commercial contract, and what are the characteristics of an insurance contract. At the end of this chapter, we would be able to appreciate what are the various nuances of the insurance contract. We would also be studying what are the various riders, in terms of life insurance contracts. So to start with the insurance contract, there are first of all some essential features of an insurance contract which are also common with any commercial contract. The first feature, first of all, we are talking about the common features, but we will be interpreting these features in terms of insurance contract. Now, the first feature is offer and acceptance. In any commercial contract, there has to be an offer and there has to be an acceptance. One party offers a particular product or service and another party accepts it. In the case of insurance, there has been a misnomer that insurance company offers the product or the plan, and the insured person who wants to get insured, they accept it. No, the first offer in insurance contract comes from the person who wants an insurance. We call him the prospect because he's a prospective customer. In terms of proposal form, we are talking about the offer in the legal sense. There may be marketing plans before that by the insurance company. The company's personnel might have approached the person, but that doesn't come in the offer. So the first offer comes from the prospect in the shape of proposal form. So proposal form acts as an application for insurance, wherein he gives all his details and it has to be given complying to utmost good faith features and complying to insurable interest. So the company acceptance is from the underwriting department of the company. They assess the claim, they assess the proposal form and they try to assess the risk, and on that basis they ask if it is accepted. They send their terms and conditions to the prospect, which is also known as the counter offer. So now this acts as the counter offer when they say that yes, we have accepted this condition. So after that, the final acceptance has to be again from the prospect. So that means there are two stages of offer and acceptance. So final acceptance is from the prospect, wherein he accepts the offer, this counter offer. The second basic essential feature of an insurance contract is consideration. Like any other commercial contract, there has to be a consideration. If I am buying a television set for my home, then I have a consideration that the showroom is providing me a TV set of a particular brand, and that particular showroom has the consideration that I would be paying the money equivalent to the worth of that. Similarly, in an insurance contract, consideration has to be from both the parties. Say from the prospect, the consideration is that he will get some assured or some insured on the happening of a particular risk which is specified in the contract, or whatever, or the damages, some insured or damage or compensation or damages, you can say, in the case of general insurance. Whereas for an insurer, in the case of life insurance, they will continue to get the premiums for the term of the policy. Whereas in the case of general insurance, normally the contracts are 1 year duration, so unless and until they get the premium, they do not issue the policy. So that is the consideration for both of them to continue with the contract. If any of these consideration breaks in between, the shape and the characteristic of the policy may change. The third aspect of the feature is capacity to contract. First of all, let's talk about the insured or the prospect. In the case of life insurance, the prospect should not be minor. There cannot be any contract with a minor in the case of life insurance. In the case of life insured being the minor, the proposer has to be the guardian or the parent of the child. It cannot be the minor child himself or herself. So therefore, should be of sane mind, should not be insane, should not have been declared insane, should not be under the influence of any intoxication or under the influence of drugs at the time of making the contract. things are necessary. And whereas in the case of life insurance and general insurance, now the regulating bodies have made the regulation that a person should be at least, that the person, the same regulations are there. They have made regulations for agents and other people, those who want to sell the insurance. We are talking about the insured and the prospect. Similarly, for insurer also, the capacity to do the contract that the insurer, it should be a licensed company, it should have been granted license by the regulating body, it should operate according to the laws of the land, it should maintain its solvency, all those things. Addendum is again a Latin word. The meaning of addendum is of the same mind, or we can say in the same sense. If there are two parties who are participating in a contract, who are the parties to the contract, they should understand the terms and conditions of the policy of the contract in the same sense. It should not happen that one is interpreting it in different way and another party is interpreting it in different way. They should be of the same mind. If one party wants to purchase a land and another party wants to sell his land, they should be of the same mind. They should know what this land consists of, what is the value, there should not be any misinterpretation. So there should be consensus between the two parties. Legality of the object. Basically, all these features also apply to other commercial contracts. Legality of the object means the purpose for which the contract is being made should be legal according to the law of the land. There can be a contract. For example, there can be a killing contract. One person can give a killing contract to another person to kill a third person. In that case, there is often an acceptance. The other, there could be consideration. One person will kill, another person will give the money. It could be capacity contract. One person has the capacity to pay the money, other person has the capacity to kill. They both are understanding it in the same sense. That it's a murder. He may not call it murder. He may say that yes, you have to do this particular thing. So, but they are understanding. They are interpreting in the same manner. But it's not legal according to the law of the land. There cannot be any contract. There cannot be any written contract. So, legality of the object is also very important. We have seen in the past, in the case of many financial companies, chip fund companies, they had run away because they had promised very astronomical amounts to the people, which was not possible. So, therefore, for this, the regulating bodies are there, the regulating agencies are there to check this thing, that the companies should be capable to pay the claim when the need arises. Similarly, the insured should also be in a capacity to pay the payment. So, again, this example will come, a person may pay a premium. In the case of life insurance, one time a person may pay a premium. But if there is a moral hazard, he may die by the next year that comes. We should be capable of paying the premium for the next, say, 20 years, 25 years, the term which he is stolen from himself. The last basic feature is that there should be intention to create legal relationship. Basically, this is different from point number 5, wherein the objective should be legal. Here, there should be intention. It should be given a legal shape. If two persons are buying a piece of property, if they just make a contract verbally, then it can't be, one person cannot sue the other in case of any breach of promise. So it has to be, there has to be proper deed, there has to be proper registration of that particular property. Similarly, there has to be proper policy, that it should be properly scanned. So legality, which gives it a legal entity. So these are the basic features which we have interpreted in terms of the insurance contract, which you would find otherwise in any other commercial contracts also. There are few other features which distinguish insurance contract from other contracts. We'll just quickly go through those features also. Now we will say distinguishing the feature of adhesion. What is the feature of adhesion in the case of insurance contracts? Basically, an insurance policy is issued by an insurance company, whether in life insurance or in general insurance. So, the terms, conditions and the provisions, they are fixed by the insurance company, by the insurer. Either they are accepted by the proposer or they are rejected by the proposer. The proposer doesn't have any say in making the terms and conditions. So it is not a bargaining contract. Number 2, another feature is they are called valued contracts. Life insurance contracts are valued contracts because there is a certain value associated to that contract. That is why we call sum assured. It could be say 4 lakh, it could be say 5 lakh. On the death of a person, this particular amount is given. So it's a valued policy. Whereas in the case of general insurance, it's not a valued policy in the case of general insurance. Then there is another feature that these are conditional contracts. Life insurance contracts are conditional contracts because it depends on consideration, because it depends on the payment of premium. If the payment of premium stops, then either the policy may be lapsed, or the policy may not be able to deliver, or the policy, in the case of life insurance, may be just able to give only the paid up value, or just the surrender value. Then another feature, again, it's a unilateral contract. The promise of giving this money on the happening of an event is made only by the insurer. There is no such promise made by the insured as such. So it's a unilateral one. And another feature which is called an aleatory feature. Aleatory feature, it makes us entirely different from other contracts. Aleatory features means in return of a small amount of premium, the insurance company promises to give a high amount. There is a lot of disparity between the amount which is given by the insured and the amount which is promised. But there is it's a conditional also because it will be given only on the happening of a certain event. Whereas all other commercial contracts are commutative contracts. Basically, we are paying the value equivalent, more or less theoretically equivalent to the product or services which we are buying. So these are the various features which distinguish it from other contracts. We will be talking about life insurance plans in our further chapters. But before that, in this chapter, we have to cover what are riders. Rider is an additional benefit given in life insurance plan. We will study it in the context of life insurance only at this stage. These are additional benefits given to the insured, of course, in lieu of nominal but extra premium. But then these additional benefits, one cannot take them on standalone basis. They have to be taken only when one has taken a base plan. In very simple and common language, we can say that these are a kind of accessories. If you have bought a bike for yourself, a motorcycle for yourself, and you want to buy an accessory, for example, you want to buy seat covers, you want to buy the mud guard for it, you want to buy some extra lights, some extra horn for your bike. So these are accessories. You would normally buy those spare parts only when you have a bike. Otherwise, there is no use of those accessories. In this case, the insurance company would not give you riders unless and until you have bought the basic plan from them. Some of the common riders in life insurance are accidental death benefit, ADB. So sometimes the company may give double, or sometimes company gives some extra death benefit. For example, if the person's basic sum assured is, let's say, 5 lakh, but if he takes this additional rider by paying an extra premium, for example, on a particular age, the premium for this 5 lakh is, let's say, if it is a term insurance policy for 5 lakh for a particular age, let's say the premium is 5,000 rupees. For endowment, it would be much higher. For money back, it would be still much higher. For a term insurance, let's say the premium is 5,000 rupees. For an ADB for that particular age, maybe rupees 150 rupees. For a sum assured of 5 lakh, 200 to 500, because the rate commonly is 1 rupee per thousand sum assured. So for 5 lakh, it would be 500. So it can be at the most 500. This is the common rate which is prevailing in the insurance market today. So in lieu of a small premium, one can double the sum assured, 5 lakh plus 5 lakh. And normally at young ages, the possibility of a risk is due to accidents only. So it's a prudent call to take this rider. There is another rider prevalent which is called permanent disability benefits. In case of an accident, a person doesn't with death, but on the other hand, he or she becomes disabled. Permanent disabled, there are different definitions of permanent disabled when a person is not capable to indulge in a gainful employment. So in the case of PDB, again, in lieu of some extra premium, either sum assured is specified, some companies give another sum assured, some companies give some extra benefits, say 10% of sum assured for next 10 years. So these are different benefits by different companies. and it depends upon the amount which he has taken under this rider. Then there is another rider which is known as waiver of premium rider. If somebody has taken this waiver of premium rider, normally this is also associated with disability, permanent disability. So in case of permanent disability, further premiums are waived off. The person need not give the further premiums. Sometimes this waiver of premium rider is also with children plans. In the case of children plan, suppose one of the parent of the child dies, or the main proposer dies, let's say the father dies, then the premiums, further premiums of the child policy would be waived off. There is another rider which is very prevalent in insurance company, which is known as critical illness rider. Earlier it used to be known as a dreaded disease rider, ED rider. Now companies are calling it critical illness rider. They specify different illness. Some companies specify 8 illness, some companies specify 10 illness or 12 illnesses. Common illnesses being covered are cancer, paralysis, blindness. Illnesses which are specified in case the insured contracts any such illness during the term of the policy, that particular sum assured which he has taken under this rider is released to the sum assured. There is no need to provide the treatment details to the insurance companies, only the diagnosis report is necessary for this. This is not like a Mediclaim or the health insurance plans or general insurance companies wherein one has to submit all the bills. It's not as in the case of indemnity in this case. Whereas in general insurance, all the plans have to adhere to principle of indemnity. A person has to give all the hospitalization bills, all the medicine bills. But here in this case, only a diagnosis report has to be submitted, and the sum assured under this rider totally is released to the person. Then we would quickly look at what are deductibles. Riders are most common, as I told you, with the life insurance companies. There is another concept which is known as deductibles. Deductibles are most common with non-life insurance or general insurance plans. Common type of deductibles, we say excess. For example, just to give you a quick example, in the case of commercial vehicles, for example, in case of any loss or damage to a commercial vehicle, the excess amount is, let's say, just a few months ago it was 1500 excess amount. That means the first 50, any claim amount, if suppose the claim amount is 10,000, then 1500 is the first amount of the claim which the insured himself has to bear. So the claim amount released by the insurer would be 8,500. So excess amount is 1500. In the case of commercial vehicles like taxis or trucks or buses, this is the excess amount. It is not very prevalent nowadays, but as a theoretical concept, excess is prevalent, franchise is not prevalent. For example, there is a franchise of 1500. For example, if the damage is say worth 10,000, in the case of franchise, this won't be deducted. The full claim amount will be given. This means 1500. For example, the damage is only say 1200 rupees. Then nothing will be given in the case of franchise because the first 1500 it says he has to bear. But any claim amount beyond 1500 will be given in full in the case of franchise. But in the case of excess, the first 1500 has to be borne by the insured person. So if in this case 1200 is the loss and nothing is payable here, nothing is payable here. But in the case of loss of 10,000, 8,500 is payable here, full 10,000 is payable. Then there is another concept which we'll have to cover in this chapter, which is of co-insurance. Co-insurance have different, it's understood in different parlance. In Indian context, we understand co-insurance as insurance, an object or a property or an asset which has been insured with different insurers. Let's say it is also insured with A insurance company and also with B insurance company and also with C insurance company. It happens in the case of large industries where the amount of risk is more. So the risk can be insured with different insurance companies. This is called co-insurance. All these three insurance companies shares the risk according to their sum assured. For example, there is a risk whose value is say rupees 1 crore. Let's say they have insured it for 50 lakhs, they have insured for 25 lakhs, C has insured it for 25 lakhs. In case of any damage, the claim has to be shared on pro rata basis as per their insurance. Also releases the claim in full and then again recovers the amount of pro rata share from the respective company. So this is the concept of co-insurance which we understand in India, whereas in other countries like in US countries, co-insurance has got different connotations. Their co-insurance is where the insurance is being shared by the insured as well as the insurer. A particular asset of 1 crore, say 15 lakh is the loss of 15 lakh would be shared by insured, and another say 85 lakh. It could be any ratio. It could be say 25, 75. It could be 30, 70. So in case of any damage, so here the insured party has decided to self-insure this portion of the risk. In case of any damage, again they will calculate the pro rata basis. So the loss which comes under the account of insurer, they will pay. The rest they will have to bear themselves in order to cut down their premium costs, basically. So this kind of co-insurance is being adhered to. So these are the both different forms of co-insurance. Unilateral contract. Unilateral means there has been a promise by only one party, and forcible promise has been made by one of the parties among the two parties of the contract. And that one party is the insurer, because insurer is issuing the policy. In that case, I would say that since this contract is also is of adhesion contract, because terms and conditions are being designed by the insurer himself. The insured has no say in it. It's not a bargaining contract. So therefore, they have to give an undertaking that yes, we will pay you this much amount on the happening of this event. And then they have to specify what is that event, what are the exclusion, what are the parts which are covered, what are not covered. This is understood that insured will continue to pay the premiums. But there has not been any undertaking. If you are talking about proposal form is a kind of declaration about the material facts, about health and other material facts of a person, or in the case of non-insurance, the material facts about the property or the asset. But there has not been any undertaking that yes, I will continue to pay the premium. So that is why it is a unilateral contract, because enforceable promise has been from one party only, that is insurer. So after considering all those conditions, once the insurance has been granted, now they cannot refuse the claim in case of the unfortunate event. Whereas in the case of non-life insurance, because principal indemnity applies, so therefore this concept of co-insurance basically is sharing of the risk. Here there is no sharing of the risk.
Thank you, sir.
Thank you.